The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Welcome to our monthly Lunch and Learn webinar. Today's topic is all about banks and in particular discussing why my banks won't lend. The host of today's webinar is Ian Priest. My name is Melanie Halstead. I represent BizSmart and help organise the webinars. Ian has been a banker for 31 years. Recently, over the last 3 years, he's been independent, helping business owners deal with their bankers. He worked closely with a group that has raised over £250 million since the year 2000 for national businesses. And in particular, over the last 2 years, Ian has helped raise £13 million for local businesses. So I'd like to introduce Ian Priest to start the presentation.
Hello, my name's Ian Priest and I'm a banker. It's okay, I am better now. The aim of this presentation is to have a look at some of the challenges facing commercial borrowers, look at what's going on with lenders and why people are struggling to get finance. Briefly, I will tell you a little bit about independent banking consultants. We'll have a look at the climate and where banks are at the moment, and then we'll talk about how you go about getting and keeping finance. So independent banking consultants have been trading since June 2000. We're all experienced and fully qualified lenders. In fact, we're all qualified ACIB, which is Associate of the Chartered Institute of Bankers. Individually, we've all got at least 33 years experience. In my case, that's nearer 35. We arrange finance and advise on bank and business issues. And as Melanie said, we've raised over £250 million raised to date. We are also full members of the National Association of Commercial Finance Brokers. So, the present lending climate. Cheap money has gone. A few years ago, it was easy to get money out of banks. Banks were falling over themselves to get as much money as they could out the door, and banks really got involved in things they shouldn't have been getting involved in, and then came the credit crunch. And all that changed. Money's definitely in shorter supply. Banks no longer compete so strongly for borrowers and certainly aren't competing on price. Lending has become much more difficult. It's hard, but not impossible. When the credit crunch happened, I was managing a business centre for Clydesdale Bank in Herefordshire and Worcestershire. We had £26 million work in progress, all that was about to draw, and it was all pulled. It was all cancelled in one go. So why is life more difficult? Well, in the long term, no one benefits from undercapitalised banks or from banks taking undue risk. Apart from the losses that the banks have incurred over the last few years, the regulations have changed to make sure we don't get into the same mess again. Basel III is an international regulation, and that has increased capital requirements and liquidity requirements for banks. The Bank of England has taken back a over-regulation of banks, and its first act was to order banks to put in an extra 25 billion of capital. So what does that actually mean? When banks lend, the vast bulk of the amount of money they're lending is not theirs. It's yours, it's mine, it's people's savings. What restricts a bank's ability to lend is the amount of capital that they hold, because they have to have a percentage of each loan is capital. So if they haven't got enough capital, they can't make the loans. Increasing the amount of capital that banks have to hold reduces the amount of lending they can put out. So Actually, in terms of risk for the economy, making banks hold more capital and liquidity is a good thing. However, it means to continue lending, banks will have to earn and retain bigger profits, and they need that to make up the losses over the last few years. They have to attract external investment, or they have to get government assistance, or if they can't, they have to reduce lending. And we've seen what's called net lending fall significantly over the last 5 years, and it's still reducing now month on month. And my prediction is it will continue to fall for the rest of this year at least. Net lending is the difference between the amount banks lend each month and the amount they've had back in repayments. In reality, there are only three options. Government assistance is completely off the agenda. As we saw in Cyprus, the position has moved from where it was at the start of the crisis 7 years ago, and they let the banks in Cyprus fail. Anybody who's got savings needs to remember that depositor protection across the UK is 85,000 per depositor per organisation. And you have to be careful because some organisations are all part of the same group. So, for example, Bank of Scotland, Lloyds Bank, Halifax are all part of the same organisation. So you only get one lot of 85,000 per person across all those three. So they're having to put more capital in. That means they're having to put more of their precious resources in, and that inevitably means margins will increase. The days of banks lending at 1 or below percent over base, where they weren't making any profit on it, has gone. They were lending at those rates to try and attract business, to try and sell other products. That's really been knocked out the water. Interest rates typically these days start with a minimum of a 2. It's very, very rare to see anything less than 2 over base. I've already said net lending will fall, and despite what the government say, net lending will continue to fall for the rest of this year. The Bank of England are already concerned about overheating in the mortgage market, and net lending includes mortgage lending. And in fact, the new regulations that came in 2 months ago on mortgages have cut the amount of mortgage money going out the door significantly. Banks will seek to reduce facilities, and that means existing facilities already out there, they'll be cutting overdrafts or switching overdrafts to loans, or even to invoice finance. So what can you do about it? You need to manage your relationship with the bank carefully. They are a very, very important supplier. You need to stick to covenants and terms. Read your facility letter. Make sure you understand exactly what the covenants are and what the conditions are on your loans and your overdrafts, and make sure you stick to them. They will be looking for any excuse to put the pricing up. You have to present applications for funding properly. You need to give the banks all the information they need. I'll come back to that a little bit later. If in doubt, get some help. You can't afford to wing it. You only get one chance to get it right. What else can you do? Look around the marketplace. Banks aren't the only lenders. There's lots of specialist asset-backed lenders out there, and that covers hire purchase, leasing, invoice finance, single invoice finance. There are socially responsible lenders like Backcountry Reinvestment Trust, Aston Reinvestment Trust, and there's a local one in Worcester, and the name's gone completely out of my head. I'll post that later. There are peer-to-peer lenders like Funding Circle and ThinkCats. That's individuals with savings looking to lend directly to companies. And then there's business angels and venture capital. But always remember, with business angels and venture capital, they want a share of the business. So they will want shares, not just interest on their money. Get help with putting your application together. Growth Accelerator has an access to finance scheme. The Enterprising Worcester programme has people that can help you with submitting access to finance. UKTI, the government department, is great for helping businesses with exports, and they have a division they keep very quiet about called UK Export Finance that is there specifically to help finance exports. The Enterprise Finance Guarantee, a government guaranteed loan scheme, it's supposed to help banks get money out the door. Unfortunately, the banks don't like it because it doesn't do what it says on the tin. But look at all the options. There are more funders out there than just the high street banks. The banks are lending. You just have to go about it in the right way. As Melanie said in the introduction, I've raised over £13 million for clients over the last 2 years. Good deals can be done, but you have to do it properly, and you can't expect the bank to be taking excessive risk. It's a tough market, there's no doubt about that. There are few sources of reliable and competent advice. Unfortunately, commercial broking is an unregulated activity, and there are, I'm afraid to say, a number of people out there peddling advice on getting finance that actually don't know what they're talking about. And then there's the big one, and that's the way banks make lending decisions, which is fundamentally flawed. I want to take a few more minutes to look at that in particular. Think about what happens when banks make lending decisions. Well, first off, there are 3 types of bankers. There are some very, very good ones, there are some not so good ones, and there are an awful lot of lazy ones. They've all got one thing in common. There's none of them got enough time. They are all swamped with the amount of work they have to do, and most of it actually is justifying their own existence or their boss's existence, but they are under immense time pressure. So unless they can see immediately that a proposition is going to get through credit, they haven't got time to look at it. If they do decide to look at it, then the process that all the banks follow is, as I've said, fundamentally flawed. Now, we'll just walk you through that process. The banker comes out, has a look round, kicks the tyres, probably gives you, the borrower, a shopping list of information. The banker goes away and writes a report, and the report gets submitted to a credit underwriter. Now, in some banks, the credit underwriter might be on the next desk. In others, he could be in Birmingham, Edinburgh, Glasgow, even India. How somebody in India can make lending decisions about a small business in Worcestershire beats me, but that's what happens. Now let's look at that process in a little bit more detail. The banker comes out, has a look around and kicks the tyres. Great. Problem is, that's the last input you as the borrower has to that process. Everything else happens behind closed doors. You have no idea what's going on. The banker writes a report. Well, sometimes they do, and actually in practice, sometimes they don't. Most bankers have got a corner on their desk that's got a mental sticker on it that says too difficult, and files could sit there for weeks and weeks and weeks. There's a dead giveaway. You'll have talked to the banker, he's gone away to write a report, and you hear nothing for 5-6 weeks. And then he'll come back and ask for some more information. And then another 4-5-6 weeks goes by, and he comes back and asks for some more information. I guarantee you he's never put pen to paper. It's sitting on that corner of his desk marked too difficult, and he's looking for a reason to say no, he just hasn't found it yet. If he does write his report, it might be great. He might have done a fantastic job. On the other hand, he might have been rushed. He might have been trying to get it finished before he goes on holiday, done a half-assed job on it, might have missed the point completely, might have just gone off at a complete tangent. You're never going to know because you don't see it. It's a confidential document. He might also be promising things you can't deliver, like performance or security that you'd never be able to give. Again, you don't know because you don't see it. And then the report gets to a credit sanctioner. I've been a credit sanctioner in 2 banks. It's a great job for a short while, but then you go a bit stir crazy. When you're sat there as a credit sanctioner, you've got 2 bits of information to make a decision on. The first bit is the pack of paper that's come in from the lender, from the banker. The second is your opinion of that banker. Now, if it's somebody you get on well with and know, like, and trust, like in networking, that's great. And you start off with a really positive attitude to that deal. Even if it turns out to be complete rubbish, you're looking for a way to do it or reshape it so that it can be approved. On the other hand, if it's somebody you've had an argument with, or you've seen something that they've done wrong recently, or a deal they've had went belly up, you could have put it to the bottom of the pile because you don't want to look at that one first thing in the morning. And you tend to look at it last thing at night when you're tired and you're grumpy and you want to go home and you've picked your red pen up before you start. Now, it might be a great proposition, but just because it's come from that lender, it's going to get ripped apart. It's going to get worse terms. It's going to get declined. It's going to have worse conditions attached to it. And none of that is the client's fault. At IBC, what we do to get around that is we do the banker's job for them. We write the credit paper that they should write if they've got the time, the inclination, or in some cases the skill to actually do it. We share that credit paper with the client so they can see what we've said about them and what we're promising about the performance of their business or offering as security. And only when the client is happy with that report do we think about which lenders to send it to. At that point, we put lenders into a competitive tender for that business. The reports are designed to lead them nicely by the nose to the right answer, and then we get them competing to actually win that business. So we do put some competition back into the market. But that takes 30 years of experience. It's not something you can do off your own bat. That's pretty much where I wanted to go today. If anybody's got any questions, then I'd be very happy to take them.
Okay, we've got a question here for you, Ian. The bank often asks for a personal guarantee. So what does that actually mean?
Okay, if a bank's lending to a limited company, they will always take what security they can from the company, usually in the form of a debenture, which is a charge over the assets of the company. But banks like to tie individuals to borrowing. So they will generally ask the directors of a company for a personal guarantee. In its simplest form, a guarantee says, if the company doesn't pay, I will. Okay, so by signing a personal guarantee document, whether that's a limited one for a specific amount or an unlimited one, you are saying to the bank, if my company fails, I will pay. And effectively, I get lots of people who say to me, yeah, I'll happily give a guarantee, but I'm not giving a charge over my house. That's fine. But what's the difference? The bank's got a personal guarantee and you've got a house with equity in it. The company fails and the bank calls on your guarantee, they can register a charge against your house to back that guarantee up. So if you are guaranteeing a company's borrowing, you are putting everything you have on the line behind it. If you have got to give a guarantee, get it limited. Get the limit as low as possible. I've just done one deal for a client who was borrowing just under £300,000. One bank wanted a full guarantee plus a charge over their house. Second bank wanted a guarantee for £150,000, and the third bank, we got them down to a guarantee of £40,000. I'll let you guess which one the client went for.
I've got another question here for you, Ian.
Okay.
It's a question that's come from Roland McMorrow. What's the best method of getting to speak to the right individual within the bank? There always seems to be a huge time wasting event, really trying to get through to the right person through call operators, etc. Even if it's just to arrange a kind of bank overdraft or business overdraft.
That's a really good question, and unfortunately, it's an almost impossible one to answer. Every bank has different systems. They've all segmented their customer base. Lloyd's, I think, have just made a monumental mistake where they've transferred effectively any business turning over less than £1 million to a telephone-based service, and it's almost impossible to get through to the right person. It depends on what size of business you are and which bank you're with, but it's perseverance or getting somebody who knows the people in the banks that can short circuit the system and get hold of the right person to get them to look at the proposition. I spend a lot of time finding my way around the different people in different banks to try and get to the right person for a particular project. But it is very, very difficult, particularly if you're a small business and you're in a telephone processing centre.
Okay, I don't think we've had any other questions come through. I'll just give it a couple of seconds in case they do. In the meantime, Ian, will the slides be available for you to
Absolutely.
issue out? So we'll get those slides sent out to all of the participants today. Just to brief you all, the next webinar is on the 14th of July, same time. And that will be a closer look into kind of understanding the process of disciplinary. This will be held by Sue Wilmot from Action HR Limited. So if you're interested in participating in that webinar, please do contact Caroline on the email address that you've been using before, and we can send you the participant details for that. No, I don't think we've had any more questions come through, so thank you, Ian. Anything else you'd like to
No,
say?
if anybody wants to email in specific questions to you, I'll forward them to me. I'll deal with them directly.
Okay. So any specific questions or further questions that you might think of, please send over to Caroline, and then we'll get those answered or put you in direct contact with Ian. Okay, thank you for listening today.